Hey investors, thank you so much for joining us. So my name is Michael from Deep Value Returns on Seeking Alpha. Today I'm very excited to have with me Louis Stevens from Beating the Market, also on Seeking Alpha. Louis, what's your marketplace about?
Hi, Michael. Thanks for having me today. In one sentence, Beating the Market is a very long-term oriented investing community. Our timeline's 3, 5, 10 years. And we look to partner with 99th percentile cultures created by 99th percentile founders that produce 99th percentile economic growth and economics for their businesses. The way we think about our investments are that we are purchasing real companies, stakes in real companies, and we are partnering with the founders in a very I would say intimate way. We work very hard to understand our founders, understand their psychology, understand what they're trying to create. And we look for founders who are betting the house on their companies, right? We're looking for founders who who have created a company with product market fit, and they're willing to bet their financial future, their family's financial futures, and their investors' financial futures on these companies. And we think all of these ideas increase the odds of owning successful investments over 3, 5, and 10 years.
I mean, that's great. Thank you so much for sharing that with us. Particularly talking about kind of like the high growth names, a lot of the high growth names have had a really difficult period in the last 3 months. Opendoor also has been affected to a certain extent, partially as a high growth company, also as a de-SPAC trade, which I suppose we'll kind of address in a moment, like about the lack of near-term profitability. So could you just say how high growth names have been in the last 3, 4 months? How has that kind of played out? How do you see that?
Yeah, well, I think it's about par for the course considering inflation. The way that I'd characterize the last 3 months, it's not, in my opinion, it's not 3 months. I think February 17th was the peak, and it's actually been a full 12 months of very deep unwinding for a lot of names out there. But of course, once inflation really started printing high, 7, 10%, the reality is probably closer to 15, 20%. And I'm not going to speculate on inflation. I have no idea truly where inflation will arrive over the next 12 months. But once that started getting printed, the trade, the mindless algorithmic kind of, I call it the insufferably ironic trade, has been to sell growth companies that are growing. And I say insufferably ironic because if you look at what drives stock returns over the long run, only 1% of companies produce effectively all of the returns. And those 1% of the companies are the companies that can sustain 20 to 30% compounding revenue and free cash flow per share growth over a multi-decade time horizon. But these are the companies that get thrown out, in the near term, due to this kind of mindless algorithmic trade. But we see it as opportunity. We're of course, we've gotten beaten up pretty bad. I think it's, our service is called Beating the Market, but the market has been beating us up pretty bad. But we know over the long run, everything, will work out very well, and we're not concerned about it. We have been using this period to just, as aggressively as we can, continue to accumulate some of our favorite ideas, and one of those ideas is Opendoor.
Yes, superb. Because I'm also invested in Opendoor. I have a very concentrated portfolio. Opendoor, for the sake of disclosure, is also a stock that I'm bullish on. It's one of the stocks that Louis is bullish on. So that for the interest of the viewers' disclosure, Opendoor has been growing really, really aggressively coming out of Q3 into Q4. Do you reckon that is it possible to like for the business to continue to grow at a reasonable rate over 2022? Do you think that's possible?
Yeah, well, I think it's going to grow exceptionally well. And so I run Beating the Market with a gentleman named Ahan and a gentleman named Jared. And Ahan and I were discussing it yesterday. And we think, and we can talk more about this, but we just think the Opendoor business model is just so simple. We think it is vastly easier than the market is making it out to be. The market is, in a sweaty panic over over real estate macro factors, all of this stuff. But we see the business model as so profoundly simple. It's crazy. And well, I guess it's worth talking about the business model
Yeah,
to
please
answer
tell me,
your
like,
question. So
explain to the viewer that may not be very, very familiar with how Opendoor works. Could you just say what the business does?
at the heart of Opendoor is the idea that certainty and convenience deserves a premium. So you can think of Opendoor like snacks at a movie theater. The certainty and the convenience of showing up to the movie theater and purchasing snacks, it commands a premium, and a lot of people don't want to pay that premium, but a lot of people do. A lot of people are willing to spend $6 on a bag of M&Ms when they could get it for $1 at the grocery store. So at the heart of the Opendoor bet is it's a bet on convenience. We have to ask the question, is there a large market in which real estate sellers are willing to part with their properties for less than comps in a given neighborhood? Effectively exchange convenience for money. If the answer is yes, then Opendoor should be a wildly successful bet. The second component of the thesis is the idea that homes, for the most part, and there are certainly exceptions, but homes for the most part are commodity assets, meaning that a DR Horton or a KB Homes development or Dreamfinder Homes development, Opendoor can go into one of these neighborhoods, determine the price per square foot, determine the long-term trends, determine the average, based on the comps in the neighborhood, and then go in and say to sellers that want certainty and convenience, effectively sell their homes in 24 hours, deal with nobody except for Opendoor, and maybe an appraiser and an inspector who operate Opendoor's proprietary Opendoor Scout platform. In 24 hours, the seller can liquidate their commodity home asset. And when Opendoor started, they were taking 12 to 15%. They were paying 85 to 88% of comps in a neighborhood, right? That's if we could go into a neighborhood and pay, a house costs 100K and we pay 85K, and we can flip that in the course of 45 to 90 days, that would be a very good business model. So the Opendoor business model is it's certainly not rocket science. With that being said, the execution is very challenging. But okay, so that kind of today I do want to say that, okay, so coming back to your question, what are our expectations for 2022, right? So we think about Opendoor and we say, okay, the business model is very simple. It's challenging, undoubtedly. Coming back to what I was saying, what Beating the Market's about, we're looking for founders who are betting the house, who are betting their financial futures, their family's financial futures. There's no turning back. There's no plan B. They've landed the ships on the island. They burnt the ships. They are on the island. Their only path to survival is making this business model work. We're looking for those founders. So what are, with all of this in mind, what are our expectations for 2022? What I was saying to Ahan yesterday was, if Opendoor, the business model is not hard, and they're betting their financial futures on the company. They're all in. They bet the house. Eric Wu specifically. If they wanted to, they could just grow slower. They could just go into these commodity housing communities and say, where's the seller that wants to pay, who will liquidate their home effectively instantly for 85% of comps, 90% of comps? Where's that seller? Because we can make big money on that person, and we can just grow very gradually and capture 2% of the entire housing market in the United States, and build a business worth tens of billions of dollars, right? It's really not that much harder than that. And if they go slower, they can attach mortgage. They've already attached title and escrow. They can add these ancillary services. An interesting business out there is Porch. We don't own it, but it illustrates what could be added to the Opendoor, the Opendoor product in terms of facilitating moves, helping with TV, internet, heat or electricity, water, sewage, all of those things, insurance. There's all of these products that could be attached. So Opendoor could just very gradually scale, attaching all of these higher margin products. But and Eric Wu wouldn't be at the risk of blowing up his financial future, right? You could just gradually over a decade build a multi $10 billion business and then accelerate later on. But with that being said, they're not doing that, right? So to answer your question, what's going on for 2022? And this is I'm done rambling on here. To answer your question, if we know that the business model is simple, if we know that it can be extremely profitable, if we know that they could scale slower and not risk imploding the business, but they're doing the opposite. They're growing rapidly. They're taking a smaller cut. They're choosing to exponentially scale. In our minds, that's just the biggest indication that they feel extraordinarily confident about the future, and they feel extraordinarily confident about 2022. And I'll conclude with this: beating the market and we did a lot of work on Zillow. We sold our entire holding of Zillow at $100 a share. We're certainly not perfect, but this was a good move on our part. We sold all of our Zillow at $100 a share, 4 days before they announced they were exiting the iBuying business, because we gleaned over the course of a year that Zillow could not do it. They just didn't have the executional ability. Rich and Alan Parker are, they're too wealthy. They're not hungry enough. They just could not do the business. So they just didn't. They didn't have it.
That kind of leads me to the next question, which is like the biggest question that people always go on about. In the case of Opendoor, is it possible for them to be profitable sustainably? Because it's very easy for them to be profitable while house prices are going up. But do you think it's possible over the course of 2022 for the business to remain profitable?
Yeah, sure. It's a great question. And I will say Tesla's generated 27,000% returns, was founded in 2004, and became profitable it became free cash flow positive in 2019, profitable in 2020. So, we're of the opinion that profitability, can't be the central determining factor, or even a near-term path to profitability, right? One of the best performing stock, I think Tesla's been the best performing stock of the last 10 years, was a company that wasn't profitable for 95% of those 10 years. So, I think on the question of profitability, it just comes back in my mind to the discussion we just had, which is, if you go in and you pay 85% of comps on the comps being the price per square foot in a neighborhood, let's say it's $100 price per square foot. If you pay $85 and you can flip that in 45, 90 days, and the worst, the absolute worst decline for housing prices during the Great Recession, a once in 200-year event, was 2% per month. In the worst case, Opendoor its profitability fluctuates during very bad years for real estate. In the best case, it's massively profitable. Using that model of we're paying 85%, 80 to 90% of comps and just turning around and selling it. Now, what the reality is, they're not doing that. They've compressed, where they're paying 90 to 95% of comps, 0.9 to 0.95 of the price per square foot, the average price per square foot in a neighborhood. And to us, that just indicates how confident they are. Because again, they don't have to do that. They built a very successful business selling tens of thousands of homes at, well, I guess at the peak 19,000, but they buying and selling these homes, charging a lot more, charging a much larger premium. And by charging a premium, I mean taking 85% of price per square foot comps in a neighborhood instead of 95%, which that compresses the spread they capture, that compresses their gross margin, that compresses their contribution margin, that compresses their free cash flow margin. So and so we think long term, all Opendoor needs to generate is a 5% free cash flow margin. If long term they're paying 95 to 97% of comps, and generally speaking, real estate is an appreciating asset, generally speaking. And I also then we think, and they're adding ancillary services, then we think there's a very clear path to profitability. It's slim, the profit margins are slim, but with 4% market share in the United States, they do $50 billion in revenue. 5% free cash flow margin is about 2.5 billion, or it's 2.5 billion in free cash flow. If it can sustain 20 to 30% growth, the market will pay 40 to 60 times price free cash flow for that growth and that free cash flow. Granted, the 10-year stays below 5%. Then you're looking then we're looking at a company that's going to generate 50 to 100% annualized returns, somewhere in the middle there. I'm not saying, I'm not predicting either of those, but as of today, if it does achieve 50 billion, a 4% market share, $50 billion in revenue, and can just do a modest 5% free cash flow margin, we're looking at a massively successful investment. Yeah, so hopefully that answers.
Yeah, that answers it very nicely. And just before we wrap up, I'm going to just say as well that going into Q4, it's going to be the 19th consecutive quarter of positive contribution margins for their business. So it's a business that, for a while already has been very, very prudent, very, very responsible with making sure that those contribution margins every quarter come out profitable. Okay, I think that kind of wraps it up for us. I'd like to say thank you so much for Louis Stevenson. Don't forget to check out Beating the Market on Seeking Alpha. And yeah, and thank you so much for your time. Thanks, everyone.
All right, thank you, Michael.